It's been a fairly dismal start of the year for the markets. But is that beginning to change? The bulls were definitely in control on D Street today. The Nifty recovered some of its weekly losses in this session and closed above 17,500. The bank index was up over 2% and the Sensex up over 900 points. Analysts suggest markets had fallen due to a weak sentiment over certain stocks, including the massive sell-off in Adani Group stocks. Now, some of that fear has reversed after all the news flow in the last 24 hours. But what's the bigger picture here? Is this just a very specific reversal we're seeing in the mood on the markets, or are the biggest clouds behind us? To get a sense, I'm speaking today with Ajay Bagga, chairman of Elements Platforms and market expert, Deven Choksey of KRChoksey. With me on the show today, Pankaj Murarka, CIO of Renaissance Investment Managers, joining us, as is Sunil Subramaniam, MD and CEO of Sundaram Mutual. Welcome to all of you, and thank you so much for speaking with us on the India Development Debate. We don't often do only markets on the show, but I think this was apt at this time after what has been a bleak few weeks and months. Deven bhai, let me begin with your take. Is March looking promising?
From fundamental perspective, most of the stocks, I think, including in the front line, have corrected significantly. And I think the amount of valuation that you are now getting vis-a-vis what I think you were getting 2 months back is really become, I think, more compelling for the investors to look at India market favorably. Fortunately, majority part of the selling is appearing to get over, and probably I think most of the funds were to adjust, I think their funds in line with index weightage. That part also seems to have got over. Given that kind of a situation, I would think that the market would stabilize first before going up. Maybe I think the March end will pass by, and I think market will remain steady as I see it. The real good factor would be April to June quarter hereafter, subject to I think good monsoon and the sentiment prevailing. My take would be the market would probably start seeing gradual upside from current level. Selectively though, I think would not be bullish across the board. Selectively, market appears to be more promising now than ever before.
So, when the whole Adani saga sort of hit, and I'm going to come to Pankaj Murarka with this question, when the whole saga sort of hit, with it, there was a broader sell-off and more questions than about the Indian markets. Are we in oversold category? Are valuations, now becoming unrealistic, etc.? So a lot of the action was hinged around what was happening with this particular group stocks. Now, we know that the big reversal is because of the news flow. Do you think that's changed the mood, not just for Adani stocks, but for the overall market?
Yeah, absolutely. I think so, Tamanna, because I think, first of all, my view is that whole report in terms of whatever Heidenberg had done was extremely exaggerated, and people blew it out of proportion, saying that starting raising question mark on India's story and the fact that Adanis can default and there could be asset quality issues in the entire India's banking system. And all of that was very unscrupulous and completely unjustified, I would say, because banks have come out and said that, their exposure to Adani is very small and it's backed by assets. So I think that whole issue was completely blown out of proportion. And when you create such, these kind of news flows, it does lead to some sort of nervousness amongst investors, especially the retail investors. But I think what we saw yesterday with this large fund coming and buying $2 billion in a single day into a group of same set of Adani stock, I think that's a great vote of confidence from international investor into India growth story and specifically to Adani companies in which he is bought into. So I think all of those things which were blown out of proportion and which led to a lot of nervousness on the street are clearly behind us. The fact remains that we are in an environment where 60% of the world GDP will have negative growth this year, US and Europe. And even in this environment, India will be delivering very strong growth this year. And probably we are now the fastest growing economy in the world. So I have no doubt in my mind that over medium to long term and even this year from here on, Indian markets are certainly directionally headed higher. There could be intermittent volatility in the market, but that's the nature of equity markets. But I think markets are directionally certainly headed higher.
Ajay Bagga, what is the prime reason you see of this kind of buoyant mood today in the markets? Is this the Adani effect, the sense that the worst may be over for this group of stocks, or is this more global factors that we're also seeing with Fed decisions, etc.?
Combination, Tamanna. If you look at, we started the year with the most predicted recession in the global history, where all economists since September, October have been talking about an economic recession in Europe and US in 2023. We started with that backdrop, uh, but we had a very sharp rally in US, Europe, and Japanese equities. February saw a bit of a sell-off. India underperformed, and India has continued to underperform. Also, we saw FI outflow. So that's the backdrop. There is a slowing economy globally. There is persistent inflation, which is leading to the fear that interest rates will be higher for longer. Fed will probably raise rates 3 more times. Beginning of the year, we thought one more and we are done. So after February, March, one more rate hike and we are done. Now we are probably looking at 3 more rate hikes by the Fed, maybe two by RBI. All this is not very good for stocks. I would still say we have not made a bottom for the US market, bear market. These are bear market rallies that we have seen. We will see one sharp correction more. I don't know when that strikes us over the next few months, which will take global markets also down. The news on the economy is strong. But right now what we are finding is that good news is bad news for the markets. So the stronger the economy, the more persistent the inflation, the stronger the Chinese recovery, we are seeing the markets getting skittish because the central banks will have to more resolutely come in and raise rates higher. March 22nd, Tamanna, remains a very big risk event because the new dot plot will come in. The December dot plot was at 5.1% in terms of a terminal rate for the Fed. That is going to go up to 5.4 to 5.5. And that's the expectation will build into March 22nd. And I think markets will correct going into that. And probably after the event, there'll be some more relief coming through.
March is generally known to be a tough month. That's why you have the saying, the IDs of March. And you have a lot of generally challenges coming up. So we are although seeing a situation where the year has started off already with a lot of bad news baked in. Mr. Subramanian, how are you looking at it? Is there more pain to come? Is this like Ajay says, bear rally that we are seeing?
I think I generally agree with Ajay's analysis, but I think the bear rally he mentioned was the American markets. I do not think India is in a bear market. It's not a bear market, and this rally is not a bear rally as far as Indian markets are concerned. So let me explain what I mean. So for me, the point is that, see, Indian story of the stock market is a story of Indian growth translating to EPS and delivering returns based on EPS growth. That has not changed, right? Now, a few months ago, the Indian market was seen to be overvalued relative to emerging markets, but still FIs were pouring in money then, despite it being overvalued. Why? Because there was no other concerns then. The Adani factor came and gave a big jhatka to that, not just on the Adani group stocks, but on the other perceived exposure like corporate banks and the like to them, or the infrastructure story itself getting impacted by Adani. Now, to me, today's rally is not a human being driven rally. It's an algorithmic, a computer driven short selling, US markets going up, hence coming through. So it's entirely some data fed into some computer which led to the buying. I don't think it has anything to do with any change in India outlook, sentiment, anything. But that being said,
you're saying that the news on a big buyer coming in for Adani stocks and this 15,000 crore deal has not changed sentiment?
So what I will say is two things. So one, obviously it's had a positive impact on those group stocks, right? That you can't deny. But the second is that the fact that further bad news is probably not expected. Remember, there's still the Supreme Court thing to come out. There's
Yeah.
still the whole Hindenburg thing to come out. So we don't know whether that. But definitely an expectation this could get worse has paused, right? So to that extent, that's all that you are doing. But the point is that the if you strip away the Adani related increase today, right, there is increase in others, but it's not commensurate. See, that's what I'm saying. It's just a computer triggered algorithmic kind of a buying. But the market will continue to be range bound because risk factors around the Indian economy, short term growth, like El Nino for the monsoon, like the fact that the earnings season that just came out wasn't all humpy dory for every sector, the fact that if Fed hikes interest rates by another whatever, right? 3 rate hikes. Can RBI, because currency cannot be allowed to weaken so much, will they be forced to do rate hikes, hurting Indian growth? So there are a lot of uncertainties around the Indian story for the short term, but fact remains that domestic investors have been buying continuously through this while FIs have been selling. Do not forget that. So the market actually hasn't corrected as much as if both parties
No,
were selling.
but on the point of domestic investors, because retail investors getting the blues was also a theme that we've been seeing. A huge entry point for retail investors and a new breed of retail investors, newer retail investors, was the pandemic, of course. And this was the first sort of reality check they saw of how the mood can reverse in markets as well. Do you see that trend sustaining, Sunil?
I'm not seeing any change in our mutual fund inflows. On the contrary, net new cash has improved month on month. Redemptions have come down month on month. So the retail direct investors in the equity market are what, 15% of the free float of the market. So they're not a mass big mover. 38% is FIIs, 35% is insurance plus mutual funds. So these are the big heavyweights in the market. Retail investors could panic and the equities and do something, but in the mutual fund, I'm not seeing retail mutual fund investors panic. I don't see that any evidence on the ground there.
Okay, I want to take that retail investor question to Deven Choksey as well, where, sort of the volatility of the markets began to spook people who thought it was only going to be a one-way street. What would be your message for them right now when we're seeing some kind of reversal?
I think stay with quality. That is the first message that I have always advocated, and I think continue to advocate. Most of the retail investors have habit of getting into euphoria and probably I think get into the stocks at a time when they should not be getting into it. Second thing, when the retail investors are getting structured products like mutual fund and the advisor services, I think they probably need to avail those services. I think that is a message that I always communicate to them. Because I think the market volatility is probably, I think, not something which one can easily understand, neither can easily play with. So it is better that I think you go with a disciplined and structured approach, which most of the organized investors like funds would do. So in such situation, I think when the market is exhibiting significant amount of volatility, my take would be that I think this volatility at the best, I think should be used for the purpose of investing and not otherwise. This is the time when probably you are getting the corrected valuation. This is the time when you are getting the advantage of buying something which could possibly give you the outperformance in the market in following period. And fundamentally, I think the businesses are doing well as far as India is concerned, and I think so would be their earning outlook. I don't think that I think that has changed ever. So from that perspective, my recommendation to investor would be that stay with quality, buy quality investment stock. I think this is the time to buy and not look otherwise.
Yeah, for retail investors, Ajay Bagga, some hard truths and some tough lessons learned.
In the COVID time, we had this what's in the US called the Robin Hood armies, and
Yeah.
similarly in India, we had these online traders, and trading was seen as easy money, easy pickings. On a one-way market, it's very easy to make money, and we tend to ascribe supernatural powers to ourselves. When the market goes down, then you blame the market and not your own foibles. That's the main thing. And there has been media reports, Tamanna, that quite a few trading accounts have become dormant now.
Correct.
You are seeing in the small cap, mid cap indices, the volumes have really dried up in a number of the so-called retail GameStop kind of Indian counters as well. You had this, YouTube scam, which SEBI has penalized as well. So all kinds of malpractices were on. The good news is the mutual fund industry has really built the SIP book. That's a brilliant thing that really makes this market evergreen. It helps the market. Second big thing for me is I see the markets going down this year. It won't be very easy. Markets will bottom out before the economy. And since this year I'm not seeing even a soft landing, I'm seeing a no landing. Economies will continue to be in the positive. There won't be negative economies, either Europe or US. You will see positive growth in GDP. India, China will contribute more than 50% of the global GDP growth. I agree with Sunil. I was not mentioning bear market rally for India.
Yeah.
It was totally, I was mentioning it for the US only. So we are going to see that a problem happening in the markets, but markets will bottom out in advance of the economy and they will start going up in advance of the economy starting to recover. So timing is not something we'll get right. We should keep on regularly investing, stick with quality. What Deven bhai said, totally agree. Stick with
What are you saying to those, Mr. Bagga, who are saying today that FD hi theek hai? Look at the rates I'm getting in FD.
FD बहुत अच्छा है. FD is very good. If you're making 8.5% on fixed income, that's very good because you're not getting paid enough on the equity market. If you're going to make 11 to 12%, Tamanna, this Nifty index has not gone anywhere since September 2021.
Yeah.
So for 16 months, we have got no returns. The mutual fund guys have given returns because they are active stock pickers. SIPs have given returns because you're doing rupee cost averaging. But a buy and hold investor, if he woke up after September 2021, he finds the same market.
He said, I want to go back to sleep.
I know you go and definitely you have to invest. There are a lot of opportunities in long-term Indian government bonds, and the mutual fund guys are offering. You see the PSU AAA rated funds; those are giving very good yields at very low cost. This is the time to lock in a lot more into fixed income. I would say you're not getting paid enough for equities, but your SIP should continue for equities and stick to quality. The mid cap, small cap will pick up later after the economy goes down and economy slowdown is very much there. This quarter, you will get 4.2% on Indian GDP. You will have a shakeout again. Come April end.
No, you're right. That's mathematics, right? Because if you're looking at 7% for the year and 1 quarter left, you are in that range. Pankaj Murarka, your thoughts there for retail investors and what they should do now. They say that if the heat is too much for you, you should get out of the kitchen. It's definitely becoming that kind of scenario.
Not at all, Tamanna. I think if at all anything, retail investors should invest into India and India growth story and Indian stock markets. As far as your question about fixed income versus equities, you should look at historical data. Last 20 years, equity markets, Nifty index has given returns which are 2x of bank fixed deposit returns. State Bank of India fixed deposit, Nifty index has given returns which are 2x of State Bank of India fixed deposit over last 20 years. And bear in mind, last 20 years, we had interest rates which were much higher than what we are prevailing today. Fixed income can give, on a short-term basis, returns higher than equity, but by no stretch of imagination, anywhere in the world, fixed income can give returns higher than equity. Investors should certainly get their asset allocation right and make sure that to take care of their cash flow needs, they should invest into fixed income to the extent is required. But if you want to create wealth over medium term to long term, then equity is the asset class. Equity doesn't make you money on every day, on every month basis. There is no point in trying to time the equity markets. I haven't come across an intelligent, successful investor who's been able to time equities to the T. I think India growth story is extremely compelling. No point in trying to time the quarterly GDP and quarterly numbers. Investors should take a medium-term view on equities, and they should not think twice. Events like this, where you see sharp volatility and downticks in markets, are great opportunities to go out and invest into Indian equities because you get to buy the same set of companies at prices which are 10, 15, 20% cheaper. So I don't think so. Least of the retail investors, I don't think so anyone should try to time the market. Least should be ever be attempted by retail investors.
Right.
And just have faith in India growth story and stay invested into India from a medium term to long term. And no other asset class can beat equities come whatsoever anyone might say.
I'm interested in Sunil's take on this. Sunil, have you started, seeing more interest in your fixed income sort of investment opportunities?
So let me first explain my views and then I'll answer your question. So if you ask me, right, let me look at it as a person with a 1-year view, a 3-year view, and a longer than 3-year view. Okay. So the person with a 1-year view, if he's happy with this 8% return, puts it in a 1-year FD. Okay. Doesn't come anywhere near mutual funds. If he's got a 1-year view, at the end of 1 year with that FD, he can decide what he wants to do in investment. If he has a 3-year view, and he's happy with 8% for 3 years, then a debt mutual fund like a target maturity fund or corporate bond fund makes sense, right? But the question is he an equity oriented investor? If he's an equity oriented investor, locking his money for 3 years for 8% return, I think is underselling himself, because I believe that this year will be a year of debt, but the next 2 years equity will deliver enough returns that over a 3-year period, I think you can get double-digit plus returns from an equity investment, right? So then what do we do with that kind of a person? Obviously is worried for this year. So with the 3-year outlook, I would say go into the hybrid category, right? You have balance advantage funds where the fund manager takes the call. The problem with debt mutual funds and taking 1-year call is that taxation hurts you big time. You got to be 3 years to get indexation benefits, right? Whereas the balance advantage fund can go up to 100% debt, 100% equity. Fund manager rotates that based on the market view, and you suffer only equity taxation. So that's the best with a 3-year outlook. Go for a balance advantage fund. I think healthy double-digit returns, which are double the FD returns on a post-tax basis because of the lesser tax for. If you have a 3-year plus view, blindly, I agree with what Pankaj said, buy India, buy equity of India and stay in the multi-cap space, because when India really grows, small cap, mid cap, both will rise and FII return will help large caps. So all the three are bound to do well. So to that extent, I think it's very clear. 1 year, bank FD, 3 years, do balance advantage funds unless you're satisfied with 8% for 3 years, and greater than 3 years, put yourself into a multi-cap, flexi-cap fund, which will deliver to you very good inflation and FD beating returns. So now to answer your question, are we seeing greater interest? The HNI category, which is very rate sensitive and which is very risk sensitive, right, is allocating more to target maturity funds.
Okay.
We are seeing that happen at our counters, that there is interest in corporate bond funds, rolled on maturity products where you lock into the yield. The HNIs do asset allocation. So in that debt component, they feel it's a good time to lock on for the debt component. But the equity component, they are remaining it in a broader equity space.
All right. So, no matter what happens, the basics don't really change when it comes to investing. I think that's the key takeaway. Stick to the basics. Thank you so much to all of you for joining us today on the show.